Decoding the Balance Sheet. Strategic insights for modern accountants. The balance sheet stands as one of the cornerstones of corporate financial reporting, offering a snapshot of a company's financial position at a given moment. This critical document reveals total assets, liabilities, and shareholders' equity, providing stakeholders with essential information to assess solvency, liquidity, and overall financial health. In today's dynamic economic landscape, understanding the nuances of balance sheets is more vital than ever. As regulatory frameworks evolve and stakeholder expectations grow increasingly complex, accountants must master both traditional and emerging aspects of this foundational statement to drive informed decision-making across organizations. Understanding the core components of a balance sheet. A balance sheet comprises three primary elements: assets, liabilities, and shareholders' equity. These categories form the fundamental equation of accounting: assets equals liabilities plus shareholders' equity. This relationship ensures that every transaction maintains equilibrium within the financial framework of an organization. Assets represent resources owned by the business, categorized into current, short-term, and non-current, long-term. Current assets include cash, accounts receivable, and inventory, while long-term assets encompass property, plant, equipment, and intangible assets like patents. Liabilities are obligations owed to external parties, also divided into current and non-current classifications. Short-term liabilities typically involve accounts payable, accrued expenses, and short-term loans, whereas long-term liabilities include bonds payable and pension obligations. Shareholders' equity reflects the residual interest in the assets after subtracting liabilities. It includes contributed capital, retained earnings, and treasury stock adjustments, serving as a measure of the owner's net investment in the firm. Categorization precision. Proper classification of items into current or non-current is crucial for accurate financial analysis. Misclassification can distort liquidity assessments and mislead investors. Relevance of valuation methods. The choice between historical cost, fair value, or other measurement bases affects asset and liability presentation. This impacts comparisons across periods and entities. The role of balance sheets in financial decision-making beyond mere record-keeping. Balance sheets serve as strategic tools for internal management and external stakeholders alike. Executives rely on this document to evaluate operational efficiency, manage working capital, and plan for future growth initiatives. Investors scrutinize balance sheets to gauge a company's ability to meet short-term obligations and sustain long-term operations. Metrics such as the current ratio, current assets/current liabilities, provide insight into liquidity risk and creditworthiness. Leveraging balance sheet data across industries. Different sectors exhibit distinct balance sheet characteristics shaped by their operational models. Manufacturing firms often show high levels of fixed assets, while service-based businesses emphasize intangible assets like goodwill and intellectual property. Retailers maintain significant inventory balances, which require careful monitoring due to fluctuating demand cycles. Conversely, technology companies may report substantial research and development expenditures capitalized as intangible assets. Interpreting key ratios derived from balance sheets. Financial analysts derive meaningful insights through various ratios calculated using balance sheet figures. These metrics help benchmark performance against industry standards and identify areas requiring attention. Liquidity ratios such as the quick ratio, cash plus marketable securities plus accounts receivable/current liabilities, offer a stricter assessment of immediate cash availability compared to the current ratio. Solvency ratios reveal long-term viability by measuring debt exposure relative to equity. The debt-to-equity ratio, total debt/total equity, highlights leverage levels, informing creditors about repayment capacity. Efficiency ratios track how effectively a company manages its assets and liabilities. Days Sales Outstanding, DSO, calculated as accounts receivable/annual revenue, x 365, indicates average collection periods for customer payments. Liquidity benchmarks. A current ratio above 2 to 1 generally signals strong liquidity, though optimal thresholds vary by industry and market conditions. Solvency indicators. While there's no universal safe level for debt-to-equity ratios, values exceeding 1.5 to 1 may raise red flags among conservative lenders. Common pitfalls in balance sheet preparation. Despite its structured format, preparing accurate balance sheets presents challenges that even seasoned professionals might overlook. Recognition timing errors, improper disclosures, and incorrect valuations frequently lead to distorted financial portrayals. Misclassifying lease obligations as operating expenses rather than financing liabilities is a prevalent mistake impacting both income statements and balance sheets. Such errors can significantly skew leverage calculations and capital structure analyses. Underestimating provisions for bad debts or overvaluing impaired assets represents another frequent pitfall. These miscalculations affect profitability measures and erode trust in financial reporting integrity. Failing to disclose off-balance sheet arrangements appropriately poses serious risks during audits. Items like guaranteed loan facilities or joint venture participations require transparent disclosure to comply with regulatory mandates. Regulatory compliance and reporting standards. Navigating diverse accounting standards requires meticulous adherence to regulations governing balance sheet preparation. Differences between generally accepted accounting principles, GAAP, and International Financial Reporting Standards, IFRS, necessitate specialized knowledge. For instance, U.S. GAAP permits last-in first-out, LIFO, inventory costing, whereas IFRS prohibits this method entirely. Such divergences impact asset valuations and consequently influence key financial ratios used by international investors. Convergence efforts and their implications. Ongoing convergence efforts between FASB and IASB aim to harmonize global accounting practices but present implementation complexities. Professionals must stay updated on evolving guidance related to revenue recognition, impairment testing, and lease accounting reforms. Recent amendments to ASC Topic 842 regarding leases mandate new disclosure requirements that substantially alter balance sheet presentations. These changes require revisiting past financial statements for comparative purposes when presenting audited reports. Technology's influence on balance sheet accuracy. Advancements in enterprise resource planning, ERP, systems have revolutionized balance sheet compilation processes. Automated reconciliations and real-time data feeds reduce manual entry errors while enhancing audit trails. Cloud-based platforms enable simultaneous access to balance sheet data across departments, improving interdepartmental collaboration and ensuring timely financial reporting. Integration capabilities with third-party software further streamline compliance procedures. Artificial intelligence tools now assist in anomaly detection by identifying irregular patterns in asset valuations or liability accruals. Machine learning algorithms predict probable defaults based on historical data trends. Blockchain technology offers promising solutions for immutable recording of transactions, potentially eliminating disputes over ownership claims and reducing fraud risks associated with financial misstatements. Future trends in balance sheet analysis. Emerging trends suggest increased emphasis on environmental, social, and governance (ESG) factors within traditional financial reporting structures. Stakeholders expect greater transparency regarding sustainability-related assets and liabilities. Predictive analytics applications allow forward-looking assessments of balance sheet positions by incorporating macroeconomic forecasts and industry-specific variables into modeling exercises. With growing adoption of XBRL, extensible business reporting language, standardized electronic formats enhance comparability across jurisdictions and facilitate quicker data extraction for analytical purposes. The rise of decentralized autonomous organizations, DAOs, introduces novel challenges for conventional balance sheet frameworks, necessitating innovative approaches to capturing digital asset holdings and token-based liabilities. Conclusion: mastering the intricacies of balance sheets remains indispensable for accounting and finance professionals navigating today's complex business environments. From understanding basic principles to applying advanced analytical techniques, proficiency in this area drives sound financial stewardship. To remain effective in your practice, commit to continuous professional development focused on mastering evolving standards, embracing technological innovations, and refining analytical skills necessary for interpreting contemporary balance sheets accurately and strategically.